Hello and welcome to the Mint Funds Market Update for October 2025. Starting off with the US and global economy. So AI continues to be the dominant theme within global and US equities. If we look at the left-hand side, we have the infographic from the Financial Times showing the myriad of business deals, partnerships, tie-ups that OpenAI adds with a number of the largest information technology companies in the US. So just a few things to highlight here are that Oracle, Broadcom, Microsoft, NVIDIA, some of the biggest names have all agreed tie-ups over the last number of months in respect of AI capability with OpenAI and their large language model, ChatGPT. On every new announcement, individual names seem to bounce on the latest news and latest tie-ups. And as you can see, it's quite a somewhat circular diagram of different companies tying up with each other. In the minute, markets are taking this all very positively, and each name begins to surge as investors effectively bet on people who are spending money now will see the return from their investment in AI going forward as they assume some level of productivity gain across the board. If we look at the chart on the right-hand side, we see a rebased performance from the 30th of June this year for the overall S&P 500 versus just the S&P information technology sector. So the information technology sector here is in the light green and the overall headline index is in the black. So as you can see, the AI theme seems to be the dominant one. Even though the S&P has obviously gained around 6% since June, we can see that the information technology sector seems to have done that and then some. So AI continues to drive quite a lot of the headline gains we see within the index and across wider US and global equities. Turning now to the Federal Reserve. So as forecast in August at the Jackson Hole meeting, we had 25 basis point cut delivered by the Federal Reserve in their meeting in September. Key takeaways would be the cut now that leaves the federal policy rate around 4 to 4.25% range. There was only one dissenter to 25 basis point cut, and that was in favor of a 50 basis point cut, and that was the Federal Reserve's newest member, and that was Stephen Murren, recently appointed by the Trump administration. So this cut was widely expected after the labour market data came out in August and some tepid inflation data allayed fears of an inflation melt-up. As part of this meeting, the Federal Reserve provided some member views in the form of their dot plots. And as you can see on the left-hand side, most members generally are within a relative consensus for where they see the policy rate by the year end 2025. But we have one dot that's quite a bit away, and that's highlighted on the chart here at the very bottom, just below 3%. So effectively, that is the newest member, Stephen Murren's view that there should be at least 150 basis points of cuts before year end, which obviously aligns very closely with President Trump's view. However, generally across the board, these dots, ignoring the bottom one, are seen as more dovish than expected, with some of the PCE and inflation forecasts and policy rate forecasts lower than the previous updates. The market pricing is now in between 1 and 2 cuts by year end post this meeting, closer to the 2 cuts by Q4 2025. Turning to slightly less positive news for markets, we had during the month of September and up until the 1st of October, a lot of news reports on potential for a government shutdown as driven by congressional Republicans, Democrats, failing to reach an agreement to fund the federal government for the new fiscal year that actually begins on October the 1st. That deadline passed and the shutdown has been in place since the start of this month. Obviously, government shutdown is not a good thing. It puts pressure on the labour market in terms of individuals who are currently employed and getting paid, but also on headline GDP. So with all non-essential government operations having been suspended, effectively that has a drag on GDP. And Alpine Macro have estimated that each week the US government is closed is a net negative 0.2% drag on overall GDP growth on a weekly basis. Just to note, this is the 15th government shutdown lasting more than 1 day since 1980. And interestingly enough, there is potential for future increases to the unemployment rate if President Trump makes good on promises to make permanent layoffs in lieu of some of those employees that are currently furloughed. So if you look at the chart on the left-hand side, this is just to illustrate the difference between non-essential and essential workers. So the navy is effectively representing the furloughed employees, so the people who are currently not getting paid and currently off work. And then we have the light blue, which are exempt, so they are deemed essential. And as you can see, it's quite a mix, or it's quite a high number of overall employment in federal employees, but also quite a large chunk of them are furloughed, which will have an impact on overall consumer spending as people aren't getting paid. Turning now to New Zealand, there was some poor overall growth news with the weak Q2 GDP release that came out during the month of September. And effectively, that was quite a jarring result, which reset overall expectations for where the terminal cash rate will end up. So on the left-hand side here, we see the May 2026 OCR as implied by the OIS curve. And the red line highlights when the Q2 GDP was released. So prior to the release, markets were coalescing around the 2.5% mark, and that was as a function of the latest MPS forecasts from the RBNZ, effectively saying that OCR will trough around 2.55%. Once GDP was released, it was quite a miss, both relative to general market expectations, but even the worst market expectations were around negative 0.5 for the quarterly number, and the GDP number came out at negative 0.9. So as you can see, markets quickly repriced, and now the view is by the end of September that the terminal OCR, or the OCR by May 2026, will effectively be around that 2.25 or 2.2%. So effectively baking in one extra cut versus what RBNZ previously forecast. I have here on the right a table by sector for each of the sectors which contribute to the overall GDP number using the production method. So you can see the second column represents the overall headline number for the sector, the quarter-on-quarter change, and then the third column represents that contribution to the overall number. Just a few ones to highlight. Obviously, manufacturing was a weak point. We had a weak manufacturing PMI in August, and that has obviously flown through to in June, which obviously passed through to the overall GDP number. But obviously, construction continues to be a weak point for the economy. And if we look at the year-on-year numbers, down 7.6% relative to where it was in Q2 2024. Just an interesting thing to note, may not have been picked up by a lot of commentators. If we add up the quarterly contributions for each sector, you can see that there's quite a gap between what the headline number is versus what the sum of the parts indicate. So we have a balance end of negative 0.4. A few market commentators have implied that there's a higher than not probability that may be revised in coming quarters. So maybe this result wasn't as bad as everyone thought. But for now, markets have repriced based on this headline result, and yes, things have changed for New Zealand. Turning now to the two diversified funds, and I will start off with the Mint Diversified Income Fund. So asset class performance was broadly positive in September as the Federal Reserve cut rates and signaled further cuts, and New Zealand GDP surprised to the downside. So at an overall level, the fund was up plus 1.1%, with fixed income contributing plus 0.7 and Australasian equities contributing plus 0.4. And then we also had global equities coming in flat at 0%. Looking at the positive contributors to the portfolio, so within global names, we had Broadcom Incorporated up 10.9 and Oracle up 24.4, and they were the two leading names for the month. Broadcom surged after mentioning on its earnings calls at the start of the month that they had signed a deal with OpenAI for a $10 billion deal to develop further AI processing capabilities for their large language model, ChatGPT. Within Australasian equities, we had Freightways Group up 14.4% and Infratil up 8.7%, and they were the top two names for September. Freightways rode a wave of momentum from its recent earnings announcement in August, and analysts upgraded them due to potential for future acquisitions. Looking at fixed income, we've seen a large rally in interest rates as that Q2 GDP number came out in New Zealand, and yet, as I mentioned, came well and below market expectations. Even the lowest one, which was negative 0.5, and the quarterly number was negative 0.9. This caused the entire yield curve to shift down. We actually took profits on our short end OIS swap position as terminal OCR pricing moved down, adding 5 bips to overall fund performance. Looking at negative contributors this month, within global names, we had Boston Scientific down 7.5 and Comcast Corporation down 7.5 as well, and they're the two main detractors. Boston Scientific had a rough September as markets reacted negatively to news that the FDA had ordered a recall on their implanted defibrillator devices. Within domestic names, we had Goodman Group down 4.6% and CSL Limited down 6.9%, and they're the two worst performers for the month. Goodman Group suffered amid a mild sector sell-off for Australian REITs as interest rate expectations moved up in Australia with continued strength from the underlying economy, reducing the case for more rate cuts as priced in the start of September. Turning to the Mint Diversified Growth Fund. So as I mentioned, asset class performance broadly positive in September as the Fed cut rates and signaled further cuts, and New Zealand GDP surprised the downside. At an overall level, the fund was up plus 0.7%, with Australasian equities being our top positive contributor at plus 0.4%, and global equities and fixed income coming in at plus 0.2% respectively. Turning on to the individual positive contributors, within global equities, IBM was up 15.9% and Oracle Corporation was up 24.4%. Oracle jumped after their Q1's earning report hinted at a huge surge in future pipeline of revenue, with their performance obligations number up 359% to $455 billion US. That translates to effectively demand for their cloud infrastructure for AI applications. Within Australasian equities, we had Scales Corp up 12.7% and Petrol up 8.7%. Scales surged in the last days of September on news of their acquisition of Meteor Foods from Alliance Food Group for an undisclosed sum. And again, within fixed income, we've seen that large rally in interest rates with the GDP number, and that caused the entire yield curve to shift down. And we took profits also on the short end OIS opposition within the growth fund, adding 2 bips to overall fund performance. Turning to the negative side, within global equities, Boston Scientific again was down 7.5% and S&P Global was down 11.3%, the two main detractors from performance within global equities. S&P appeared to drop after its competitor in the sector. FactSet reported weak earnings and outlook guidance in the financial data platform space, and fear spread to S&P also. Within domestic equities, we had Goodman Group again down 4.6% and CSL down 6.9%. CSL continued its slump from August as the overhang from the US pharma tariff uncertainty weighed down on the stock, particularly with respect to their Behring division. This also hurt some other pharmaceutical companies with high exposure to the US healthcare sector. And that's all from me. If you have any questions, please feel free to send them through to info@mintasset.co.nz. Thanks very much.